Hello and welcome to our webinar to review the 2021 federal budget. My name is Ramy Padinama, a senior financial advisor with Asante Capital Management and a lead member of the Ferguson Financial Planning team. On behalf of Steve, Jacqueline, Norma, Patty, and Carmina, thank you for joining us today. This webinar is intended to provide a tax and program summary of the changes that were included in the 2021 federal budget, which was announced by Canada's Finance Minister, Chrysler Freeland, on April 19th. The budget was the first one released in 2 years and was greatly anticipated after we went through one of the most eventful and turbulent years in many decades. As vaccinations continue and provinces act swiftly to curb the impact of the third wave, this budget was aimed at addressing COVID-19 relief, with policies geared towards ensuring the Canadian economy was well positioned for growth after the pandemic. Over the next 40 minutes or so, we'll hear from our experts about what was tabled in the federal budget and how it might affect you. We also allocated time afterward to answer some questions you may have. I would now like to turn things over to my colleague and team member, Jacqueline Osmer, to introduce our panel of experts for today's webinar. Jacqueline?
Thank you, Ramy, and good morning, everyone. Thanks for joining today. So while Steve, Ramy, and myself do provide our clients like yourself with estate, investment, and tax planning strategies, for today's presentation, we really wanted to bring in tax expert Wilmot George and estate planning lawyer Keith Masterman. Wilmot and Keith are both vice presidents with CI Global Asset Management's tax, retirement, and estate planning team. Throughout his career, Wilmot has held progressive positions in the areas of tax and estate planning, financial planning, banking, and securities analysis. He holds numerous designations, including certified financial planner, trust and estate practitioner, chartered life underwriter, and certified health insurance specialist. Wilmot's articles have been featured in numerous financial forums like the Globe and Mail, National Post, Advisor.ca, and Investment Executive. Our first presenter today, Keith, has extensive knowledge of estate planning gained through his education, years in private practice, working at a Canadian bank, and of course in CI's estate planning division. Keith holds his Bachelor of Law degree and Trust and Estate Practitioner's designation. You may actually remember Keith from a webinar we did back on the fall on the 7 deadly sins of estate planning. We are absolutely thrilled to have such knowledgeable speakers walking through the federal budget with us here today and talking specifically about how the federal budget might impact you. So just before we begin, I want to remind everyone that this is a webinar, meaning that you can see us, the presenters, but we cannot see or hear you. So that doesn't mean this can't be interactive. If you do have a question, I would encourage you to ask it through the chat or Q&A feature, which you will find at either the top or bottom of your screen, depending on what type of device you're using here today. So the formal part of the presentation should last about 45 minutes, and we'll leave about 10 minutes at the end for questions. If you do have to log off or if we do run over, don't worry, this is being recorded and we'll make sure that everyone gets a copy so you can watch any parts of the presentation that you weren't able to see live today. And of course, you can always reach out to Steve, Ramy, or myself afterwards for any specific questions that you might have. So with that, I will pass it over to you, Keith, to start today's presentation.
Thanks, Jacqueline. This year's budget has set several records. One record is that with a lag of 761 days between its delivery and the previous budget's delivery, it set a record for longest period Canadians had gone without a budget. Partly for this reason, but more due to the pandemic and the effect it had on the lives of Canadians, this was one of the most anticipated budgets in history. It was also the longest budget in recent memory at 742 pages. Obviously, a budget of such length contains proposals on a multitude of programs, some new, some already existing. It'd be impossible to discuss them all today. So Wilmot and I and the rest of our team have combed through all 742 pages and are going to discuss the matters that most affect you. So we've broken our comments down into 4 categories. First, I'm going to start off by giving a brief overview of the overall budget. I'm then going to continue and discuss the matters of most importance to individuals. Wilmot will then take over, providing a review of the most important matters affecting business owners. And lastly, Wilmot will look at some miscellaneous matters in the budget that will have an effect on you. So on an overview, let's start with an overview of the budget. This quote from the budget document, I think, summarizes the overall theme of the budget. This is a budget that invests in growth. The best way to pay our debts is to grow our economy. This budget makes investments in jobs and growth. In today's low interest rate environment, not only can we make these investments in Canada's future, it would be short-sighted of us not to make them. The budget was heavy on investing in programs aimed at growing the economy and creating jobs as we approach the post-pandemic world. What it was not heavy on doing was raising revenue to address the national debt, including the spending incurred by COVID relief measures over the last year. Quite the opposite. As the last part of the quote suggests, the budget was heavy on investing based on the affordability of debt financing in a low interest rate environment. And invest they did. The budget proposed just under $101.5 billion in spending. Nearly 70% of that proposed spending is earmarked for the upcoming fiscal year. The big ticket items are COVID support and the centerpiece proposed national childcare program, both of which we'll review in a few minutes. Given the budget is premised on the affordability of investing during a low interest rate environment, coupled with a stated purpose of creating jobs and economic growth, it's not surprising the budget predicts a deficit of $354.2 billion, 16.1% of gross domestic product in fiscal 2020-2021. As eye-popping as that number is, it is $27.4 billion smaller than predicted in the fall update provided by the government. In large part, this is due to a stronger than expected economic rebound. The government emphasized how the record-sized deficit is meant to be a one-off, with the intention to reduce the deficit going forward. By 2025-26, a deficit of $30.7 billion is projected, which is in line with the deficits introduced by this government pre-pandemic. The deficit spending will increase the federal government's debt to GDP ratio to 51.2% in 2021-22, before falling ever so slightly to 49.2% by 2025-26. Given the anticipation of this budget, there was a great deal of speculation on what it might contain. Let's look at a few of the matters speculated, but which in the end were not contained in the budget. The budget did not touch the capital gains inclusion rate, a relief to many on the phone right now. It did not affect Canadians' ability to shelter one residence from capital gains tax by utilizing the principal residence exemption. Canadian estates are taxed at death or subject to a provincial probate rate and a deemed disposition income tax. There was some speculation the budget would introduce a new gift on inheritance tax, but it didn't. Similarly, there was no changes to the GST rate. Lastly, there was no wealth tax or the creation of a new high top tax rate, although the budget did create a luxury tax. You'll notice our slide says perhaps next time. There is speculation the government will not include did not include any of these proposals as they were currently in a minority position, and an election containing some of these proposals might mean an uphill battle for them. However, given their stated purpose that so long as interest rates remain low, coupled with the projected rebounding of the economy, increasing taxes is not a priority of this government. Should interest rates begin to creep up or the expected rebound does not materialize, we might be revisiting these matters should Canadians elect a majority government in the next election. Now let's discuss how individuals fared in the budget. From a tax perspective, there was no change to the federal personal tax rates. For basic income, you can see the federal rates on the screen, which range from 15% on the first $49,020 of income earned to 33% for those earning income over $216,512. Combining the rates with their provincial counterparts means that most Canadians at the top marginal rates are paying around 50%. With a high in Nova Scotia of 54% and a low outside the territories of 47.5% in Saskatchewan. And in Ontario, of course, we are paying 53.53% at that highest marginal tax rate. What matters were affected? Well, the following matters were included in the budget, and we're going to discuss them. A luxury tax affecting Canadians purchasing high-end vehicles, boats, and airplanes proposed to take effect in January of 2022. Several COVID relief measures, although gradually being phased out, are extended. Also aimed to assist Canadians affected by the pandemic, there has been some changes to EI. A centerpiece of the budget is the intention to build a Canada-wide childcare program aimed at reducing childcare costs and thus allowing more parents, particularly women, to return to the workforce after having a child. New OAS changes will affect seniors over age 75. Steps have been proposed to make it easier to qualify for the disability tax credit. This change is expected to mean that about 45,000 Canadians who previously did not qualify will now qualify for that credit. And on the tax side, a non-resident property tax is proposed. Turning to the proposed luxury tax, I think this quote says it all. And this is a quote from the budget. If you've been lucky enough or smart enough or hardworking enough to afford to spend $100,000 on a car or $250,000 on a boat, congratulations. And thank you for contributing a little bit of that good fortune to help heal the wounds of COVID-19 and invest in our future collective prosperity. The wording may seem a bit of a slap to Canadians already in a 50% tax or higher tax bracket, but it succinctly summarizes the new tax. The tax will apply to vehicles and personal aircraft with a final sale price of $100,000 or more, and to boats of $250,000 or more. The tax is calculated as the lesser of 20% of the amount above the threshold, that $100,000 for vehicles and aircraft and the $250,000 for boats, or 10% of the entire value of the item. By way of example, if Ramy, let's say, purchases a car with a value of $101,000, what will be the luxury tax paid by him? We know there are two ways of calculating it. He will either pay 10% of the entire $101,000 value, which is $10,100, or he will pay 20% of the amount of the purchase price that exceeds $100,000 or $200. Since 10% of the entire purchase price, being $10,100, is greater than 20% of the amount exceeding the $100,000, $200, Ramy's entire tax will be $200. But let's assume Ramy decides to buy a second car, and this one has a sales price of $1 million. What will be his tax on this car? In this case, 10% of the entire purchase price is $100,000. However, calculating it using the other method, 20% of the purchase price exceeding $100,000 would generate a tax of $180,000. Therefore, Ramy will now pay $100,000 in taxes. In other words, the higher the value of the car or aircraft or boat, the more likely it will be that the tax will be the 10% of the entire purchase price. There are a few things Ramy might want to keep in mind. The luxury tax applies to cars, airplanes, and boats sold for personal use. It does not apply if purchased for commercial or business purposes. Secondly, the tax will not apply to the sale of motorcycles, RVs, ATVs, floating homes, commercial and farm vehicles. So rather than that $1 million car, Ramy might want to buy an RV. Lastly, the proposed tax comes into effect on January 1st, 2022. So we might want to purchase that car in the next few months. Moving on, the centerpiece of the budget in many ways is the proposed affordable coast-to-coast daycare program. Outside of Quebec, which has implemented a provincial daycare system, the cost of daycare can prove to be exorbitant and a bar to a parent being able to return to the workforce. In Toronto, for instance, the average cost of daycare for one child is $1,578, about $1,600, or $18,939 per year. If a parent earns $50,000 a year, they would have an after-tax take-home pay of about $34,000. In other words, daycare would eat up about 56% of their after-tax income. And that's for one child. So people with multiple children have a bigger problem. The proposed program means daycare would cost about $10 a day, or about $2,600 per year all across Canada. The program will take about 5 years to be fully implemented and will involve negotiating reciprocal agreements with Quebec to ensure the new proposals aimed at the rest of the country and the Quebec program already in place will work together. It's estimated, given the increased number of people who will be able to return to the workforce, the program will eventually generate over $6 billion in revenue a year, in effect paying for itself. Not just children, though, let's talk about youth. Budget 2021 proposes several steps to make student debt easier to pay down and to provide direct support to students in need, including, in the 2019 federal budget, it introduced a 6-month interest-free grace period after graduation for student loans. That period was extended during the pandemic. The budget extends that period again for another year. Every year, the government offers repayment assistance to low-income borrowers. Currently, the income threshold for assistance is $25,000 for a single borrower. The budget is increasing that threshold to $40,000 per year. The rate for borrowers supporting larger households is also being adjusted. Further, the cap on monthly student loan payments will be reduced from 20% of household income to 10% of household income. During the pandemic, the government started a program where student grants could be doubled for low-income students, providing an additional $2,600 on average of non-repayable aid to students in need. This program is being extended to July of 2023. The budget also proposes a change that might be of interest to a few of you if you have postdoctoral students in your family. For income tax purposes, postdoctoral students or postdoc fellows are generally not considered to be students. Thus, postdoc income generally does not qualify for the scholarship exemption for income tax purposes. Although fully included in taxable income, postdoc income does not currently qualify as earned income for the purposes of determining an individual's contribution limit to a registered retirement savings plan. The budget proposes to include postdoc income in earned income for RSP purposes, providing postdoc fellows with additional RRSP room. This measure would apply in respect to postdoc income received in 2021 going forward. It also, if you apply, if you apply to CRA, will apply to any postdoc income received from 2011 to 2020. So you might get an adjustment in your RSP contribution. Of particular interest to older Canadians, but also of interest for those contemplating retirement, are the proposed changes to OAS. Government programs, being Old Age Security, the Guaranteed Income Supplement for low-income Canadians, and the Canada Pension Plan are important sources of retirement income for many Canadians. In fact, a study by Scotiabank recently showed that 58% of Canadians say that their retirement income will be dependent on OAS. A CIBC study reported that 80% of Canadians listed OAS as being an expected portion of their retirement income. The budget proposes a one-time payment of $500 in August of 2021 to OAS pensioners who will be 75 years of age or over in June of 2022. It also proposes to increase regular OAS payments for pensioners 75 and over by 10% on an ongoing basis as of July 2022. Currently, OAS pays $618.45 a month. The 10% increase will represent a monthly increase of $63.83 for a total monthly amount of $682.28 per month, or a yearly increase of $766 in the first year. And remember, this is inflation, indexed to inflation going forward. The budget also announced the government's intention to implement a national annual 1% tax on the value of non-resident, non-Canadian owned residential real estate considered to be vacant or underused. This tax was effective January 1st, 2022. The budget, by the way, does not define underused. The goal is to ensure non-resident, non-Canadians owning real estate pay what the government calls a fair share. The tax will require all owners other than Canadian citizens or permanent residents of Canada to file a declaration as to the current use of the property, with significant penalties for failure to file. That filing will happen once a year. In the coming months, the government will release a consultation paper inviting comments on the proposed tax. The government is specifically looking for comments about whether there should be special rules for small tourism and resort communities. I believe one of the most significant changes in the budget concerns the disability tax credit. A quick recap of the importance of the credit before we review the proposed changes. The disability tax credit is a non-refundable tax credit that helps persons with disabilities or their supporting persons reduce the amount of income tax they have to pay. Currently, to be eligible for the DTC, an individual must have a certificate confirming that they have a severe and prolonged impairment in physical or mental function. The effects of the impairment must be such that even with appropriate devices, medications, and therapy, the individual is blind or is markedly restricted in their ability to perform basic activities of daily living, or significantly restricted in their ability to perform more than one basic activity of daily living. The Income Tax Act lists basic activities when considering eligibility for the certificate. As important as a non-refundable tax credit is, qualifying for the disability tax credit offers so much more from a planning perspective. Being eligible for the DTC can open the door to other federal, provincial, or territorial programs, as it's required for various programs, including opening a registered disability savings plan, receiving the Canada Works benefit, and the child disability benefit. The disability tax credit also allows for post-mortem planning, in that it is a requirement to designate a testamentary trust as a qualified disability trust, which, unlike almost all other trusts, is subject to graduated tax rates. If you wish to learn any more about these opportunities, contact Jacqueline, Steve, or Remy, and we'd be more than thrilled to talk to you about these opportunities. So what are the changes? In effect, there are two, both aimed at making it easier to qualify for the certificate. The definition of mental function required for everyday life are being expanded to include such things as impairment in judgment, perception of reality, and verbal and nonverbal comprehension. Secondly, more activities in determining time spent on life-sustaining therapy and to reduce the minimum required frequency of therapy are also being added. As I said earlier, it's predicted that this loosening of the rules will mean that 45,000 more Canadians will qualify. This is a great opportunity for those with children who have a disability to do some planning. Before I turn it over to Wilmot, let's very, very briefly review a few of the changes to the COVID relief subsidies. Should you require more information, again, contact Jacqueline, Remy, and Steve, and we'd be more than thrilled to talk to you about these. We just don't have the time right now. The programs affected by the budget are the Canada Emergency Wage Subsidy, the Canada Emergency Rent Subsidy, the Canada Recovery Benefit, and the Canada Recovery and Caregiving Benefit. If you're like me, you get them all confused all the time, so I'll try and summarize what they are and what the changes are. The Canada Emergency Wage Subsidy, available to employers who have experienced a drop in revenue during the pandemic, is currently scheduled to expire in June. However, the budget proposes extending it to September 25th. The subsidy amount is a function of the percentage revenue decline experienced by the business. Currently, the maximum weekly benefit is $847. Starting July 4th, the subsidy amount will decrease so that the maximum amount will be $677. Then, for the period commencing in August 1st, $452. And for the final period commencing in August 29th and ending in September 25th, it'll be $226. In addition to the gradual decline in the program, the budget also proposes that should a public corporation receive a subsidy and pay its top executives, which generally means the CEO, the CFO, and the three other highest paid executives, more in 2021 than in 2019, they must repay the benefit for periods beginning after June 5th of this year. The Canada Emergency Rent Subsidy is available to businesses who experience a drop in revenue during the pandemic to cover commercial rent or property expenses. The program, which was to wind up June 5th, will be extended to September 25th, although with a declining subsidy rate scale. For businesses which have experienced a 70% or greater decline in revenue, which is the highest rate subsidy bracket, the subsidy rate will decline from 65%, which is the current rate, to 60% in July, 40% in August, and finally 20% in September. So it's being wound down. In addition, the government earlier introduced a lockdown support for businesses that were forced to cease operation or significantly limit their activities due to a provincial or federal lockdown order. The subsidy is in addition to the regular Canada Emergency Rent Subsidy benefit and is also extended from June to September. The subsidy rate will remain at its current 25%. The Canada Recovery Caregiving Benefit provides support for Canadians who can't work because they're caring for a child or a family member who needs supervised care. This past February, the government increased the number of weeks available under the program by 12 for a total of 38 weeks. The budget will extend the program once again for another 4 weeks for a maximum of 42 weeks at $500 per week. The government is also seeking the power to extend the program if they deem it necessary to November 20th of this year. The Canada Recovery Benefit provides income support to employed and self-employed individuals who are directly affected by COVID-19 but aren't entitled to employment insurance, the EI benefits. The budget extends the program by 12 weeks for a total of 50 weeks, but payments are slated to be phased out. A lot of these programs are being phased out. The first 4 additional weeks will be paid at the usual $500 a week, which is the program's rate now, then reduced to $300 a week for the remaining 8 weeks. The program is expected to end September 25th. Again, the government is seeking power to extend the program to November 20th if they deem it necessary. And finally, the budget proposes increasing the federal minimum wage to $15 an hour. Where a provincial or territorial minimum wage is higher, and the only one higher is none of it at $16, everyone else is $15 or lower, the provincial rate will apply. Also designed to assist low-income Canadians, the budget proposes to enhance the Canada Workers Benefit, which can provide about $1,000 more a year to low-wage, full-time workers by changing the phase-out rate at which the benefit begins to reduce from $13,194 to $22,944 for an individual, and from $17,522 to $26,177 for families. Secondary family earners will now be able to exclude up to $14,000 when income testing for this credit. So those are the changes that involved individuals. I'm going to turn it over to Wilmot to talk a little bit about business tax matters.
Thanks very much, Keith. Appreciate the opportunity. I am just going to share my screen. I think, Keith, you're gonna come off there and give me an opportunity to share, and then I will share my screen and we will continue on. So if one of my colleagues, Keith or Remy, Steve or Jacqueline, let me know if you can see my screen, and I will continue on. All right, good stuff. So my job now for the second half of this talk is to talk a little bit about business matters and to talk about some other miscellaneous items that were in the budget that might be of interest to you. So thanks for the time. Let's get right at it. In brief, similar to personal taxation, there were no changes to corporate income tax rates or the small business limit for 2021. The general rate for business income beyond $500,000 remains at the 15% level federally. Of course, there's a provincial tax on top of that. And the small business rate remains at 9% for business income up to $500,000. Investment income rates also remain the same, although they're not shown on this slide. Now, there was one exception to this rule, and it's specifically for tax rate that apply to manufacturers of zero emission technology. There's a temporary tax rate reduction for companies that are engaged in that type of green activity. However, we don't think the temporary rate reductions will apply to the majority of taxpayers. I'll talk about green initiatives as we move through the presentation. So while a broader look at budget measures are included in our budget summary, we prepared a budget summary that you can access through our friends at Asante if you're interested. But specifically in my talk, we're going to discuss a new Canada Recovery Hiring Program for businesses, a consultation on mandatory disclosure rules to combat aggressive tax planning. We're going to look at a temporary tax rate reduction for manufacturers of zero emission technology, which I just referred to. We're going to look at depreciation for green equipment. And we're also going to look at a limit to interest deductibility for certain, but not all taxpayers.
Wilmot, can I just interrupt you for a second? Sorry. Would you be able to expand your screen? It's just a little small. We're seeing, I think, the presenter's view.
Okay, let me just see here what I can do. Give me 1 second here. So when I go on, can you see this?
Yes, and hit slideshow. Yeah.
Yeah, it takes me back there where I was before.
Okay, I think the previous view would be
a little bit better.
Yeah, just so the audience can see a bit better, if that's okay.
Perfect. Is that okay?
Yes, thank you. That's
okay.
That's better.
All right.
Thank you.
We'll stay there. All right. So to get started, let's talk a little bit about the new Canada Recovery Hiring Program. This program is designed to provide employers with a subsidy of up to 50% on the incremental cost of bringing employees back to work as the pandemic subsides. The subsidy would be available from June to November of this year, and employers would be able to claim either the CEWS, which Keith talked about a moment ago, or this new benefit, the higher of the two, but not both. Now, depending on which qualifying period is being claimed, we're eligible. The subsidy would be between 20 and 50% of what they call incremental remuneration, 50% being June through August, and 40% in September, 30% in October, and 20% in November, subject to an employer's COVID-related revenue decline. Now, generally, incremental remuneration will be remuneration that qualified for the CEWS benefit, and the difference between remuneration paid during a baseline period, so to look at your remuneration between March and April of this year versus remuneration paid in the claim period coming after April, and that difference there is what they would apply the subsidy rate to. Now, our goal here today is not to go through every detail related to this program, okay? There are many details and the calculations are quite complex. But if you require more information on this program and you're a business owner, I encourage you to reach out to your accounting partners, reach out to the team here at Asante, and they can walk you through or provide you with more information on this particular new subsidy. The next measure we'll talk about today is a proposed consultation on Canada's mandatory disclosure rules. Sure, there are some Canadians who are familiar with these mandatory disclosure rules, a lot of Canadians who are not familiar with these rules. But in brief, according to Budget 2021, a lack of timely and comprehensive information on particularly aggressive tax planning compromises tax revenues worldwide. Early access to such information allows for quick response through audits and changes to tax legislation. Tax legislation already has rules requiring certain taxpayers to, or certain transactions to be reported to the CRA. We call these the mandatory disclosure rules. However, the Department of Finance and the CRA believe that the rules in place are not sufficient enough to address their concerns. Consequently, the government intends to consult on proposals to enhance Canada's mandatory disclosure rules. Specifically, the consultation will discuss changes to reportable transaction rules, a new requirement to report notifiable transactions, a new requirement for certain corporations to declare and report uncertain tax treatments, and extensions to reassessment periods, and also penalties. The proposed changes would apply after 2021, and definitions of these problem areas can be found in the budget papers. Okay, the government has outlined some specific definitions of what a reportable transaction is, what notifiable transactions are, right? What uncertain tax treatments are. There are pages in the budget paper that define these things. So if you're interested, you can have a look there. So, you know, those changes or these transactions or defined terms can be found in the budget papers. Stay tuned for more information from finance in the coming weeks. Now, as you think about this measure though, keep in mind that it is aimed primarily at aggressive tax planning scenarios. Okay, it likely will not impact the majority of tax compliant taxpayers and Canadians. All right, so this is aimed squarely at those who look for aggressive opportunities to avoid taxation. That said, we wanted to address this point here to point out a trend. This has been a trend with our current government. They are looking for opportunities to close tax loopholes. They're looking for opportunities to attack aggressive tax planning. And this particular measure just kind of illustrates that trend and where the government's mindset is at. Let's now move and talk a little bit about green initiatives announced in the budget. With a minority government and support required from other parties to pass the budget, it is not surprising that there is something in this budget for everyone, including green initiatives. effective for taxation years after 2021 for manufacturers of zero emission technology. A temporary 10-year corporate tax rate reduction will apply. I mentioned this earlier on. Specifically, the general corporate tax rate applicable to M&P, manufacturing and processing income, will be reduced from 15% federally to 7.5% federally, and the small business rate will reduce from 9% to 4.5%. These are federal rates. The provinces have their own rates in addition to the federal rates. To qualify for the reduced rates, though, at least 10% of a corporation's gross business revenue must be from eligible activities being zero emission technology type activities. Also, the government is expanding the list of assets that will qualify for a quicker tax write-off. We call this depreciation, CCA, capital cost allowance or depreciation. And they're expanding the list of assets that will qualify for this quicker depreciation, resulting in tax efficiency. Expanded depreciation classes will include a number of green assets not already included in this group. So the changes will apply for clean energy acquisitions after April 18th of this year and are designed to promote further investment in green technologies. Let's now talk a little bit about interest deductibility. Because indeed, individual taxpayers might engage some type of leveraging program whereby they borrow funds to earn income, and any interest paid on that loan is normally tax deductible to the extent that their investment that they purchase with the borrowed money is used to generate income or has the potential to generate income. Businesses, corporations can also benefit from this. However, interest deductibility was addressed in this budget, but not as it relates to the majority of investor clients, and you'll see what I mean in a minute. So generally, to obtain cash flow, taxpayers might obtain funding through debt, and also interest expenses related to the debt is normally tax deductible if the debt is used to earn income. Now, in some cases, however, excessive debt has been used in ways the CRA deems abusive and inappropriate, threatening the CRA's tax base. And examples include interest payments to related non-residents in low tax jurisdictions, using debt to finance investments that earn non-taxable income, or having Canadian businesses bear a disproportionate amount of multinational groups' third-party borrowings. These are all activities that the government deems to be inappropriate or abusive when it comes to interest deductibility. Therefore, Budget 2021 proposes to curb this activity by limiting tax-deductible interest expenses for certain taxpayers, specifically to be deductible, or specifically the deductible amount of net interest would be tied to a fixed ratio of a corporation's tax EBITDA, which essentially is the entity's taxable income less certain expenses, limiting the overall deductible amount relative to current rules. Okay, note though, that these rules are not likely to impact small business corporations or groups of corporations and trusts that do not have significant net interest expenses. Specifically, the new rules proposed to begin in 2023 will propose an exemption for CCPCs, which are Canadian-controlled private companies. So if you've got your own private company, Canadian-controlled private company, and it has taxable capital less than $15 million, you're exempt. Also, there's an exemption for groups of corporations and trusts whose net interest expense in the year is $250,000 or less. So the message here is that while there may be some changes coming to interest deductibility, for now, the changes appear to be targeted at larger corporations and larger trust and partnership entities that have significant amounts of interest expenses each year. Until further notice, current interest deductibility rules will continue to apply for individuals and other taxpayers that fall within these noted exceptions. Okay? All right. Let's now turn our attention to other matters of interest to both personal and business taxpayers. Specifically, we'll discuss proposed changes to CRA audit authorities, additional financing to combat tax evasion, and an intention to move forward on previously announced measures, including employee stock options, individual pension plans, and annuities under registered plans. For some time, the CRA has had broad authority regarding how to conduct audits. In brief, they could review books and records of taxpayers in an effort to confirm tax compliance and, if necessary, attend a taxpayer's premises for this purpose. Now, in a recent federal court of appeal case, the case was the Minister of National Revenue, the CRA, versus Cameco Corporation, for anyone interested. The CRA attempted to stretch their power to include requiring employees of the company to attend interviews and answer orally various questions the CRA considered relevant to the audit. The company refused to provide the CRA with this opportunity, but did offer to respond to questions in writing. The CRA took the matter to court in an attempt to force Cameco to comply with their request. The court decided that the CRA, based on the specific wording in the Income Tax Act, did not have the authority to force taxpayers to respond to questions orally, thus leaving the CRA to audit documented information only. So the CRA lost. The problem with these situations, though, is whenever the CRA loses a court case, they cross the street, speak with their friends over at the Department of Finance, and make a case to change the legislation in their favor. And it appears that that is what's happening in this particular situation. Budget 2021 proposes to grant the CRA broader authority to conduct audits by amending legislation to require persons to answer all proper questions, provide all reasonable assistance related to audits, and to require persons to respond to questions both orally or in writing in any form specified by the CRA. This measure will take effect once these budget proposals are passed and receive royal assent. So what does this mean for taxpayers? Simply put, it means a more challenging time for taxpayers when it comes to pushing back against CRA audits. Okay, sticking with the topic of audits, the Department of Finance continues to support the CRA in combating tax evasion, a mandate of this government since its election in 2015. Specifically, Budget 2021 proposes to provide $304 million over the next 5 years to allow the CRA to increase GST, HST audits of large businesses, modernize the CRA's risk assessment processes to prevent fraudulent GST, HST refund and rebate claims, and enhance capacity to identify tax evasion involving trusts and better service, provide better service to executors and trustees. Also proposes $230 million over 5 years to improve the CRA's ability to collect outstanding taxes. These new measures are projected to collect over $5.8 billion of revenue for the government over the next 5 years. And finally, Budget 2021 confirmed the government's intention to move forward with previously announced measures, adjusted for consultations since their release. There are a number of outstanding proposals from this government. Proposals the government previously announced. Perhaps they were announced in the 2019 budget. Perhaps they were announced in the fall economic statement, which was delivered in November. So there are a number of proposals that have been proposed by this government, but have not yet been implemented. The budget papers, these budget papers, the 2021 budget papers, provide the full list of those measures and have indicated that the government intends to move forward with these measures. What we want to do now is take a few minutes to discuss some of these measures, not all, we don't have time. We'll discuss 3 of them. 1, changes to the taxation of employee stock options. 2, pensionable service under IPPs, individual pension plans, and 3, two new annuities for registered plans. Generally, stock option benefits are taxed efficiently as they are taxed similar to a capital gain. Okay, only 50% taxable. Your taxable benefit is usually only 50% taxable, similar to a capital gain. However, according to the government, high-income individuals disproportionately benefit from this tax treatment, and particularly those employed at large, long-established, mature firms. So in November's fall economic statement, the government proposed changes to stock option rules, and in particular, they proposed a $200,000 annual limit to apply to stock options that qualify for the preferred tax treatment. They also proposed that options granted by CCPCs, Canadian-controlled private companies, will not be subject to the new limit, and the government's stated objective will be met, that being startups not be impacted by these new rules, and also non-CCPs, so your bigger public type employers with gross revenues of $500 million or less will also not be subject to the new limit. All right. Now, the new rules are proposed to apply to employee stock options granted on or after July 1st, 2021. Next, we want to talk about individual pension plans. This one is very interesting. And this conversation has been going on for a few years now. As is commonly known, certainly amongst financial advisors and other financial professionals, and many retiring Canadians will know this as well. When a pension member, so you're part of a pension plan, and specifically in this case, a defined benefit pension plan, when you decide to commute or transfer your benefits out of that plan at retirement, which you may have an option to do, you can transfer to what we call a locked-in RRSP, or in Ontario, a LIRA. Now, depending on the amount that you can commute or transfer, a portion of that payout that you intend to transfer may become immediately taxable. We call this a taxable surplus amount. All right. There are rules in the Income Tax Act that say you can only transfer a certain amount between registered plans. If your benefit exceeds that limit, then the excess amount is a taxable amount, which is what we refer to as a taxable surplus in the case of defined benefit pension plans. Now, this surplus amount, this taxable amount, it can be thousands of dollars and sometimes hundreds of thousands of dollars, as the Income Tax Act limits the amount that can be transferred to a LIRA. Now, for years, advisors and investors alike have been looking for ways to shelter taxable amounts when commuting pensions. Unfortunately, the available options are limited. The most common options include perhaps staying with the pension plan or transferring to a similar annuity that will provide you with pension payouts that are similar to an original plan, or making use of any available RSP contribution room. The challenge there, though, is you might not have a lot of RSP room because your pension contributions would have reduced that room. Perhaps you think about or consider flow-through investments, but sometimes there's more risk associated with those investments. You might not have appetite for that. Or some have considered transferring assets to an IPP. Now, there's a question mark beside IPP, and there's a question mark for a reason. That last bullet point there is what Budget 2019 and now Budget 2021 looks at specifically. If you look at tax legislation, it indicates that while a tax-deferred transfer from a defined benefit pension to an RSP or LIRA is limited, no such limit exists where the transfer is from one defined benefit pension plan to another defined benefit pension plan. And because an IPP is by definition a defined benefit pension plan, some have suggested that it can make sense for retired employees to set up their own corporation upon retirement, use the corporation to set up an IPP on their behalf, and then number three, transfer on a tax-deferred basis their full defined benefit pension plan credits from the original pension plan to the IPP on a fully tax sheltered basis. Now, apparently some promoters have made a business out of recommending this strategy, and many public sector workers, teachers, police officers, firefighters, who would have otherwise had no reason to set up a corporation upon retirement, have considered or engaged this strategy. Unfortunately, though, and not surprisingly, the CRA has never looked fondly upon this strategy, as it deems it to be a sham engaged for the purpose of abusing the spirit of the Income Tax Act. So to combat this, Budget 2019 stated the following. To prevent this inappropriate planning, Budget 2019 proposes to prohibit IPPs from providing retirement benefits in respect of past years of employment that were pensionable service under a defined benefit plan of employer other than the IPP's participating employer. Any assets transferred from a former employer's defined benefit plan to an IPP that relate to benefits provided in respect of what we call prohibited service will be considered to be a non-qualifying transfer that is required to be included in income of the member for tax purposes. This was Budget 2019. So to be clear, Budget 2019 proposed that any assets transferred from a former defined benefit plan to an IPP under these circumstances would be considered a non-qualifying transfer, resulting in full taxation of the transferred amount. So the message here is be careful with these strategies going forward. The government intends to move forward with legislative changes to combat these types of transactions. Now, we're not here to suggest that IPPs are bad. IPPs have a purpose, right? And if used the right way, they can be effective. We're just saying that the setup of these plans should be for legitimate purposes that do not include the sole purpose of transferring credits from an employer's plan. So we'll watch for this legislation as it makes its way through the legislative process. Budget 2021 says the government intends to move forward with this. Now, lastly, to deal with longevity risk and provide flexibility in managing retirement savings, Budget 2019 proposed the introduction of 2 new annuities for registered plans. They're calling them advanced life deferred annuities, or ALDAs, and variable payment life annuities, VPLAs. While announced in the 2019 budget, these annuities have not yet become a reality. So what are these annuities and how are they proposed to work? As opposed to having to begin retirement income at age 71, which is the case with registered annuities under current rules, an ALDA will be a life annuity, the commencement of which may be deferred until age 85. So proceeds in these annuities will not need to be paid out until age 85. This is meant to address longevity. People are living longer, require their income stream in retirement to last longer, and so on and so forth. It will be established with registered assets subject to a 25% limit, up to a lifetime limit of $150,000. And now ALDAs will not be included when calculating RIF minimum amounts, but annual or more frequent payments must begin no later than age 85. The second type of annuity, this VLPA, will be narrower in scope than ALDAs, in that they're only available for certain types of registered assets, PRPPs, which is pooled retirement pension plans, and defined contribution RPPs. And as opposed to having to transfer these assets to other retirement plans to create a retirement income, Budget 2019 proposed to amend the tax rules to permit these types of plans, PRPPs and defined contribution plans, to provide a life annuity to members directly from the plan, so in-plan annuities. Now, VLPA payments would vary based on investment performance of the underlying annuities fund and mortality experience, so it's going to be based on a bunch of different things, but these 2 plans are intended to provide more flexibility in retirement, and some would be eligible. Some might choose to use them, some might choose not to use them, but they are bringing additional flexibility to the retirement market. So given that the introduction of these products has been on pause for a couple of years, we can expect more information on setup and features in the weeks or months to come. All right, I think that more or less covers it. It covers our formal remarks for today. Lots of details, lots to sift through. In fact, as Keith mentioned earlier, there's 740 plus pages of budget papers. It makes for some good bedtime reading. One of the largest budgets in history, if not the largest. For information on the budget, you can look at any of these resources. The first one is the budget papers, which can be found on the Department of Finance website. The second one is a federal budget summary written by our team here, the Tax Retirement and Estate Planning team at CI. We know that our partners over at Asante also have a budget summary. We actually worked with the Asante team in preparation. We worked together on that, so they have that available there as well. And the third item is our team, our Tax Retirement Estate Planning team website, where we've got a whole host of articles across a broad range of topics, including federal and provincial budget summaries. So with that, I want to say thank you for your time. Thank you for attending this presentation. We will now turn it back over to, is it Remy or Jacqueline? Let's turn it back.
I'll take over.
Who's going to set us up for next step? Jacqueline, over to you.
Thank you so much, Keith and Wilmot. Definitely, this was a really great summary of those 740 pages. Truthfully, I'm not sure if everyone's going to read through those, so I appreciate you guys doing that and then summarizing it all for us. A couple of questions that we did have, if we just have a few moments left. Keith, at the beginning, you mentioned specifically that the main takeaway from the budget you felt was that it was strong on economic growth, but not necessarily on revenue generation. So really, someone's going to have to pay for all this at some point, right? So whether it's a conservative, liberal, or NDP government in the future, do you guys see anything in terms of raising taxes sort of on the next budget? Like, are we going to see more, do you think?
Well, I mean, I thought it was interesting when he said someone has to pay for this, that Wilmot suddenly ducked down and disappeared. So we know it's not going to be Wilmot. He's going to duck it. This budget was aimed at, I believe, because it was a minority government. I think that the government couldn't put an awful lot of revenue generation into this budget and expect to win a majority, which they obviously covet in either a September election or early spring election, probably a September election or October election. If we return them with a minority, if we return the government, or if we elect any majority government, I think the next government's going to have to look at this and say, you know, these deficits are a little high. We're going to have to do something to raise revenue. You know, I mentioned in my part of the presentation that the deficit projected in 2025 is going to be 30 billion. And I said that's in line with this government. But don't forget that 3 years ago, when the government introduced a deficit of about that much, we were all gasping and saying this better be a one-off thing. So I do think there's going to have to be a reckoning. And, you know, stopwatch is right twice a day. So this might be my moment. Don't take me at my word. But I believe that they're going to eventually look at an inheritance tax of some sort of gift tax, because I think it's an easy thing to do because it doesn't hit you till you're dead. Secondly, I think that they will probably play a bit with the capital gains inclusion rate. And I think they might, and I realize this is getting kind of tricky, but I think they might look at the capital gains tax on residences and have a tier where if it's below a certain tier, it's non-taxable principal residence, but above a certain tier, a certain level, it would be. That's my prediction. Wilmot, do you have a prediction on it?
You know, it's really tough, Keith, and I think you did a great job there. I mean, it's really tough because the truth is, you know, even though we sit in this seat, and what I mean by that is we look at tax, retirement, estate planning legislation every day. You know, we don't know what's going to happen, right? This is really all crystal ball stuff, right? And just based on what we hear on the street, we try to get a sense for what might happen. And I think Keith hit on all the, you know, all the main points there. You know, this whole thing with the capital gains inclusion rate, truth is, we've been talking about this as an industry for years now, and the potential increase to the capital gains inclusion rate. And you know what, that may very well still be on the table going forward. It's going to depend on a lot of things. I don't know if the government themselves know what they're going to want to do or what they're going to do in a year or 2 years or 3 years. And a lot of that will depend on who the government is and what kind of support they're going to get, right? Because, you know, right now we've got a minority government. If we continue with a minority government, then you need support. Well, where's that support going to come from? Is it going to come from the NDP? Is it going to come from the Green Party? What do they want? What do their platforms say? All this stuff is going to play a role into what might happen in the way of taxes going forward. If there's an election and then we end up with a majority government, then everything changes, right? And there might be other measures that the government will want to push forward, and they might pay less attention to the mandates of the other parties. So it really just depends on what's going to happen here over the next few years. You really do got to take it day by day, you know, month by month, year by year, and see kind of where we end up. But on Keith's point, you know, the question I guess was for me was, you know, what do I see? Are there any other opportunities here? I think this government is going to continue to try to close what they perceive to be loopholes. I think they're going to continue to look at the Tax Act, continue to look for ways to combat aggressive tax planning, and perhaps offshore taxation as well, to try to generate some revenue, in addition to a lot of the things that Keith mentioned.
Can I mention one other thing that just sort of popped into my head? I think that if you listen to Secretary Janet Yellen last week, or I think it was week before, and her plea, which was taken up quite enthusiastically by our finance minister, that democracies should look at their business tax rates and try and determine a tax rate for businesses throughout the world that is more or less on par. I think you're going to see that move forward. I think Secretary Yellen is going to make it a big part of her term as Secretary of Commerce. And I think you're going to see the Canadian government looking at that and saying, is there an adjustment to the business tax rates as a result? There you go.
Okay. Well, thank you. Thank you for that insight on that topic. I guess time will tell. Ultimately, we will be sure to incorporate any of these proposals or changes into our financial plans and investment plans that we do. We will wrap up now, but I did want to say that if anyone had any additional questions, please feel free to reach out to the team here at Asante, and we will make sure that everyone gets a recording of today's session in case there's any parts they want to watch again. So at that, I will say goodbye now, and thank you so much again, everyone, for your time, and especially to our speakers, Keith and Wilmot.
Thank you very much.
Bye.
Bye-bye.
Bye now.